just been a crazy March. So much news, globally, locally, elections, war, politics, Fed, everything is just been getting compressed in 15 days. And the world is getting compressed. It's evident how the bull and the bear cycle has actually moved in last couple of days. Maneesh Dangi joins us now. I'm just going to shift gears from stocks and micro to big picture and macro investing. Manish, you've been guiding our viewers in terms of the sequencing of events ever since last October in terms of what to expect. So as you indicated that bond yields have gone higher, crude prices have gone through the roof, and now Fed has increased rates. In your macro understanding, how will the sequence now play out?
Good morning, Nikunj. So, in a typical of any macro cycle, you've seen all of the things that you've mentioned. Alongside, of course, you had to throw in a war and a massive volatility in crude, which some of it, which has of that has unwound. But if you heard Fed yesterday, they've sort of brought down the growth estimates, and whereas of course for supply side and past demand side, the inflation still remains an issue. They were pretty hawkish actually. Of course, asset markets celebrated it because the peak war is behind us, oil has subsided, and so which is why let's take sort of equity in a while, but the 2-year treasuries actually went up by 10 basis points. So in a sense, we are getting into a setup, Nikunj, now when Fed is hiking first time, they're starting to actually bring down the growth estimates. There was a pretty substantial growth, drawdown or rather reduction of growth estimate for 2022, from near 4% to 2.8%. The 2 10s, which is the yield curve, has actually narrowed quite substantially, just at about 23, 24 basis point now. Again, suggesting that many commentators you would have heard, the risk of recession in US has risen. So what a wonderful 6 months transition it has been, Nikon. In September, we were discussing of Goldilocks, easy forever, crude low forever, to now, very, very high crude, high metal prices, Fed sort of super tight, super hawkish. And of course, you've seen, Europe, NASDAQ, many markets like Turkey, Russia, are completely getting decimated. So the transition at a global level, Nikunj, has happened from sort of mid-cycle to late cycle already. And some of the sort of bleeding is already played out in many of the markets. Of course, we should discuss India separately, but, that's a big macro setup as I see today.
Okay, if asset prices are a function of interest rates, and if interest rates will go higher, and if there is a fear of genuine slowdown because what is happening to Russia, what will happen to Europe because of energy, and what is happening to China because of COVID, then are we in for not volatile, but are we in for bumpy days? There's a difference in volatile. Volatile is that you go up and down and you settle, and bumpy is that you fall and you fall hard.
Nico, you're absolutely right. Basically, we are not living in routine times. At least in last 35, 40 years, especially in developed economies, you've never had transition from low inflation to not just high, but extraordinarily elevated inflation when growth conditions are actually weakening. So that's the problem of inflation, Nikunj. When inflation is sort of moderate, it's kind of works as a lubricant. But if it is very high, then it actually begins to work as friction, and because it dampens the consumer sentiment. You see many countries like even Europe and of course more specifically US, consumer confidence have come down to levels when we saw in the dips of March 2020, when the corona was actually raging first time and people were shit scared. That's the kind of setup the consumer is in now, that he thinks, there was a survey done in US, I think a week ago, where most people actually think that US economy is already in recession. That's an average guy thinking. So the point is that, inflation is a lose-lose trade for all assets. and for economy, which is why Powell actually emphasized that the price stability is a precondition. Last night also in the press conference, that the price stability is a precondition for growth and sort of full employment. So basically, inflation hurts consumer, we all know, but it also hurts, corporations, Nikunj, contrary to what many sort of bottom-up investors believe, because earnings actually in hyperinflation, inflation that you're seeing in US and perhaps even in Europe now, earnings don't keep with inflation. And markets begin to then sort of begin to actually price higher yield forever to discount the future cash flows and therefore lowering the PE, which is what happened in 1970s. So I guess, my sense, Nikunj, is that, the setup we are in right now, to compare this with 2003-8 or 2010-18 or 18-19 also is wrong. I think, of course, we are not in 70s as far as US is concerned, but there are many signs that conditions are sort of very, very quickly becoming like 70s, where both demand shocks and supply shock coexist, and it could very well become sort of a double dip sort of setup for economy. And for asset markets, we're already seeing a lot of volatility. So you're right that these setups actually do create a lot of volatility with downside bias.
Good morning. This is Nantara who's joining in. Picking up from what Nikunj was talking about, and I'd like to return a little bit to the basics. You had said to stay invested passively because there was so much volatility. This is not the time to dial risk. But with a big global event out of the way, where there's some sort of certainty that's coming in, would you say that this is now the time to maybe change strategy, to start deploying the cash, to start maybe loading up on risk as well?
Nentara, if you sort of zoom out, since we discussed about, investing passively and staying out of small, mid cap and active bets, you see in last 6-7 months, Fed has moved from, let's say Fed was, markets were pricing less than one hike actually back in July, August, September, to now markets are pricing 7 hikes in this year. Oil is no more a speculation, that I cited then. It's moved from $70 to $100 and stabilizing here, a war or without war. The CAD of India has moved from 1.5% to 3% and actually flashing further red. There is a geostrategic decoupling and splitting of the world, economic decoupling, sort of taking place to a certain extent between US and China camps. And of course, the growth numbers have been pretty much revised everywhere. There is a serious risk of recession in Europe. I would say 3 in 4 chance, and 1 in 4 chance that there will be a recession in US. Indian growth numbers actually been pretty abysmal. You've seen IIP numbers. You've heard commentaries from a lot of durable and actually consumer players. You've seen, that the growth pretty much actually declining across the board, even in India. So I'm afraid, I think from a transitioning point of view, now you have to think whether we are actually already in late cycle, and therefore, instead of, being invested in passive, I would actually draw down further and say that sort of begin to raise cash even further. I understand that today's markets rally and the ferocious rally that you've had in last 2-3 days, all of that would still happen in, bad environment because it's about positioning. But I would still bet that, this, boom cycle, both in economy and stock markets, perhaps may have already ended. And we are staring at, sharply slower growth, not just in US and world, but also in India for next 6 to 12 months, with a risk of double dip and a significant risk that, asset markets continue to underperform for next 6 to 12 months.
Maneesh Dangi, I remember having you on ET Now a few months ago when you were talking about maybe you would take cash out from the equity markets and buy farmland. You've also in the past talked about reducing your exposure to energy, particularly long crude. Has there been any change in your strategy? Where are you deploying your cash now?
So, from a macro asset allocation point of view, I think that cyclically we are headed to, even in India, which is a bit of a late trade, we're headed to late cycle, a period in which you have high inflation and both bonds and equities actually sort of not doing too well. And because inflation exists, even the cash hurts you, but there is a way to earn 6-7% easily. It's for 6 more months. My advice and what I'm doing to my own money, and of course of the folks that I manage this money for, is that I'm still sitting on cash. A very large part is actually converted into dollars, because I think that there is a risk over next 3 to 6 months for dollar to or rupee to sort of back up and US dollar to appreciate even now. So I think I would still wait out. In Nendera, there is a significant opportunity. You've seen, US treasuries moving from 1 to 2. I won't be surprised if Indian treasuries actually, or Indian 10-year bonds actually move towards 7.5%, and state government bonds sort of move towards 8% in next 6 to 12 months. And that's where, you would sort of make a reasonable bond bet, if the equities does not plummet by then.
Maneesh, about 10 days back, you'd made the observation about what falls first. And, you said that the sequence of what breaks first is first banks, then capex plays, then the rest of the financial plays, and then urban consumption, and then finally rural consumption. Now that it at least seems in the near term the market may have found a durable bottom, will the recovery as well be in the same sequence, or will the recovery be X these sectors? And in particular, I'm worried about banks, because for an overall market recovery, and a healthy one at that, banks need to pull up.
Absolutely. And I think to a certain extent, Indian banking cycle is sort of experiencing a separate cycle. Its asset quality is unlike, US, Europe, perhaps would stay intact because they did not underwrite a lot of risk in last couple of years. And most of the past losses have been accounted for. But nonetheless, if, let's say, crude were to settle at $120, $30, which is not my base case, but if that would depend upon how escalation and war plays out, I think that's pretty bad news for banks. Right now, I sort of continue to think that we are in a wobbly market, a lot of volatility with no straightforward returns, over next 6 to 12 months. And I think, given that the current account deficit is already 3.5%, it's very unlikely that this level of crude and this level of ammonia prices would be transmitted to Indian consumer, because they will not be able to absorb all of this, which essentially means that there is almost a 60 billion worth of trade shock that India has had will to a large extent be absorbed by government of India. And which basically then sort of takes you back to the budget day that, that you and I were excited about for the large capex play that India could have unveiled. The probability of that has come down dramatically. So I think, capex, not just, India, but across the world, because governments would absorb this big energy shock, which is what Japan, Europe are doing, and very likely India is going to do, because we're not hiking our pump prices yet. And same thing with the fertilizers. I think we will end up having, government spending a lot less on capex, and therefore, in this setup, even the private capex will not come and play. So basically, if you are betting on banking because industrial credit will pick up, I think you're going to get disappointed. If you're betting on capex, here or anywhere else, it's very likely that you'll get disappointed. So I think the setup is still, I don't think we're out of woods. I know markets have rallied by 5-6%, but I still, would actually be careful about that sequence. And I still think that, that sequence plays out where I'm not sure whether banking underperformed dramatically, but the capex does.
Sure. Maneesh, is this recovery also coming in somewhere with an assumption that the RBI is going to follow suit along the lines of what the Fed has done? Not what the dot plot is indicating, that 6 more hikes this year, but a 25 bips hike at least. And if that were to happen, would the markets be able to digest that, or have they already?
So the RBI's, reaction function sort of has been a very interesting one. This time they sort of are edgy, and they're actually flirting with markets until markets do not give up. Especially when I say market, from RBI standpoint, it's a USD INR. they sort of are fine, doing a little bit of a financial repression. India's inflation is not low. It's 6%. Of course, it's not as ugly as what you see in US, but you're very likely to, see high WPI in India, which is 13%, convert into high CPI in India over the next 6 to 12 months. So I won't be surprised if we head towards 7%. Whereas our overnight rate is still, we all know, I mean, even the repo is 4%. Overnight rate is actually close to 3%. So there is a very sharp negative interest rates in India. Now, because everyone in the world is doing it, I guess RBI is sort of allowed to commit to that sin. But in the end, this too shall unwind at some point in time, and I would say in knee-jerk fashion. So, but I have to admit that RBI has been right about their practicing financial repression, meaning actually offering negative real rates to a saver, has not resulted in a run on their currency. So to that extent, they've certainly placed growth ahead of what do you call it? Offering real rates to saver. You see that the whole thing has been flipped for US. Now it's actually placing financial what do you call it, inflation or price stability ahead of financial stability. And in fact, yesterday, if you heard Powell, he actually made an argument that you have to tighten financial conditions to actually achieve the very goal of price stability. I think the reverse sort of plot is in play in RBI. So far, so good. But I guess, I still think that you will see about 4 rate hikes, 3 to 4 rate hikes in India. But I think India's chief problem, we've discussed many times, is about high fiscal deficit. And how are you going to borrow 10.5% worth of GDP equivalent of fiscal deficit? I think at some point in time, when RBI sort of backs off, the interest rates in India can rise very, very sharply. So my sense is that we will settle at somewhere between 7.5, 7.75 in a year's time on 10-year bond.
Interesting. Manish, always great speaking with you. Thank you so much for taking the time out.
Thank you.